Hello and welcome to a brand new show of Market Makers. Just when everything was looking strong and charged up for global equity markets, we saw an ugly Monday, a Fed-induced sell-off which in a sense rattled all major asset classes. Should one buy the dip, or are we on the verge of what could be called as a risk-off mode, and we could see a synchronized sell-off in emerging markets along with other markets? So let's discuss the global scenario, local scenario, talk a bit about valuations and mega trends, and to discuss all that and much more, Ravi Dharamshi is back with us. Ravi, fantastic to have you back and thank you for joining us.
Thanks, Nikunj. Always a pleasure.
We've got you back when things are looking slightly topsy-turvy. A week ago, things were only looking up. Now, the good old Fed concerns are injecting some degree of volatility.
Yeah, so you said it right. We've been on an uptrend for 7 months in a row post, I think, the budget. It's been 7 months, barring that 1 day of Brexit dip. We've been on an uptrend continuously. Historically, the volatility has been at a real low world over. So it was but natural, but it was par for the course to expect that we'll hit pocket of volatility somewhere along the way. So doesn't come as a surprise at all. Yeah, maybe the fall in the developed markets is a little more exaggerated than it is in the EM markets.
So how are you investing in this kind of a market? You know, globally we can talk about all the doomsday prediction. There are a lot of naysayers, there are a lot of fence-sitters, but locally it's never been that good for Indian economy if I look at a relative comparison and also an absolute comparison.
So you said it right. So the other day I saw the interview that you took with Rakesh ji, and he was talking about this being a 2003. But I would just like to say that, I mean, if we have only 2003 and 2008 as the only two reference point, we might be actually making a lot of mistakes. So I don't believe that market cycle is at a 2003 phase, but I think what he meant was that the earnings cycle are at that kind of a bottom, where we've been through a prolonged period of slowdown. We've been through like 3-4 years of continuous downgrade in earnings. And now we might be entering a virtuous cycle where the earnings might get upgraded.
Why do you say that?
There's a confluence of good monsoon, confluence of reforms, confluence of government spending having some trickle down, maybe some additional kickers like stimulus, like 7th pay commission. All that will add to the economy getting a leg up. So we can debate how prolonged the recovery will be, what extent the recovery will be, but there is no doubt that there is going to be a recovery in this year.
There will be a marked improvement in earnings, economy is healing. The trajectory may be slightly uncertain, it may be gradual, but eventually the trajectory is headed higher, which is what we want to understand from equity investors like you. But stock markets have already run up.
Yes.
Stock markets always run ahead of the time. Markets are already pricing in a strong earnings recovery. So when the earnings recovery would kick in, some would argue that ye to pata tha.
The last time we were at these levels in Nifty terms in 2015, IT, pharma, consumer were the sectors leading it. And if you see, those sectors have been going through a correction, time-wise, price-wise correction. So you cannot say that those sectors have froth at least. Yes, there are issues, regulatory issues, or whether it is slowdown in the economy for the consumer. So because of which there has been a nice and beautiful rotation into the under-owned, and this has been an under-ownership rally. The metals, the PSU banks, the industrials are the ones where ownership has been low, and the global funds that even emerging market as a whole was under-owned. That's why the slight trickle from the developed markets, and there has been a rally in the emerging markets, and India is leading that wave for sure.
Okay, so let's talk about sectors one by one, and let's talk about your favorite sector. We know it by now, pharmaceuticals. Some problems are real, some problems may get sorted out when it comes to manufacturing. But is this one of those days where you should buy fear? I mean, you should always go against the tide if you want to get best bargains, and good news and good prices, they don't come together. Right now, there is a lot of bad news in the sector.
Right, so you're absolutely right about there being bad news. So I would just like to make a little bit difference. You cannot look at pharmaceutical as a homogeneous sector anymore. The various companies are going through their challenges, and which company is where in terms of solving their challenges is going to determine whether you should be invested in that company or no. So if you have a company that has just passed through all the FDA issues and they do not have any amount of unsustainable one-time earnings in their profit numbers, then I think that's a safe bet. But So the various leaders have been facing challenges because of that. The base generic portfolio in US has been facing pricing pressure for the last 5-6 months, which is what is getting reflected. And it could probably have to do with the US election cycle. We don't know for sure. And if that is the case, then I think sooner or later, Indian generics are the lowest cost producers, and they will be the last man standing, and we will gain market share for sure. So if India today would be at roughly somewhere between 13 and 15% market share in US generics, this number is bound to go to about 25% over the next 3, 4, 5 year period. Picking the right player is definitely more than 50% of making money in pharmaceutical. So I cannot make a blanket statement, pharma is good or pharma is bad. I have to be very picky and choosy about what I buy.
But the stocks which you've liked historically within the pharma space, your preference towards those names have not changed?
No, we have not changed in any significant way our preferences.
Every time a reboot happens in a sector, the big guys, they get better, the small players, they get weeded out. The example is Amazon survived 2000 storm. Amazon today is one of the biggest company in the world. TCS, Wipro survived. TCS, Wipro and Infosys, they survived the 2000 meltdown. Today they are the big league boys.
Right.
Can a similar thing happen in pharma?
So first of all, I don't think that the challenges are so grave as in where like what 2000.com bubble was. So yes.
Survival of the fittest, let me put it
right.
this way.
So I feel majority of Indian companies will survive this phase. They will come out trumps, and as a country, India would have built great entry barriers because of this. We would have a base of intellectual property, we would have a base of regulatory and compliance standards which other countries will find difficult. And of course the natural advantage that we have in terms of cost and people remains.
Where are you picking your spots? Let's talk about 2 or 3 big trends then.
Okay, so let me first say specialty chemicals. Okay. Now this is a very
that's the
jargon and it's a very heavy word, specialty chemicals. And chemicals, everything falls under chemicals. So first of all, from the morning that you get up to the time you go back to bed, every product that you use will have chemicals, even the food that you eat.
Of course.
So from toothpaste to whatever toiletries you use, everything will have chemicals. It is an all-pervasive nature. Let me give a startling statistic. So the global chemical industry was about $3 trillion in 2001. It moved to $4.5 trillion. Now $4.5 trillion is way bigger than IT, way bigger than pharma and many other global sectors. $4.5 trillion, and can you believe what the China's size was? China was about $250 billion in 2001. It went to $1.5 trillion. So almost 80-90% of the incremental growth China took away. So US, Europe, they have been losing market share. And this sector though at an aggregate level has been growing 15%. So you can imagine the kind of business that has moved to China.
And that will now move away from China.
Now, so there are 2-3 things that have happened. One is Europe has implemented something called a REACH program, which means basically they want the chemical companies and their entire value chain to be certified and brought up to a certain level of compliance standards with environment. Second, China is facing pollution issues. And third, we have become competitive vis-a-vis China. And the fourth is we have a base of companies over here who can deliver to a little extent to the global demand.
So that's a great point. First there is size,
correct.
Then there is need, then
correct.
there is efficiency.
Yeah, and there are players who can address that need.
Okay.
And so dyes and pigments is one area within specialty chemical where there has been tremendous problems in China. It's the most polluting industry and there are thousands of plants that have shut down. They are being incentivized and penalized. So the overflow of that is coming to India. India has about 3% market share. We see that going to 4.5% market share in 5 years. It will still be a small fish in the overall scheme of things. But that is a huge 50% growth for a sector. The companies can easily grow at the rate of 15 to 20% over the next 5-10 years. That's a huge, good growth rate and a long runway that these companies have. And it doesn't matter what happens to the global liquidity flows, this trend is going to play out. We might have one year up and down, but this is an example of one trend that is definitely going to play out.
So you like specialty chemical. Within specialty chemical, you like companies which are into the pigments and the dye area.
No, there are many companies and many areas that I like, but dyes and pigments are the most immediate beneficiaries.
Anything else you like in the specialty chemical?
No, so agrochem is definitely one that we have been bullish on, but we didn't look at it as a specialty chemical initially. That is not, now that we understand that agrochemicals also come under specialty chemicals. There are other niche areas. So the beauty of the space is that it is large, but there are small niches. There is fragrance and flavors, there are surfactants, there are personal toiletries, there are many segments within which
it's not a complicated sector, but
it is complicated until you uncomplicate it. But once you will have to go through the rigmarole of getting your hands dirty and understanding it a little bit, and once that is developed, so the nature of the business is quite simple.
According to, there are world-class opportunities, and chemical could be the specialty chemical could be the next mega trend.
It's the next 10-year trend for sure.
And you like diagnostics. That's the buzzword. And normally money is not made when you buy cherry consensus. If I look at the diagnostic sectors, 3 companies have just gone public, and all of them are trading at P multiples which are lofty in nature.
Yeah.
Why do you like that sector?
So it's a huge opportunity. First of all, I think it's about 37,000 crores, if I have my numbers right, is the size of the industry. And the top 4 players combined have about 2,000 crores. Top 4-5 players.
Highly unorganized.
Yeah, so it's a very fragmented industry, which is undergoing some consolidation. So the larger guys will gain scale and they will attain advantages over the smaller guys. So there would be about 90,000 standalone tests, those labs. And there would be about only 15-20 organized players. And organized as I mean above 50 crores of revenue. So in that space, now first of all, why I like this space is the huge opportunity. Second is the gross margins. They make insane amount of gross margin, anywhere between 70% and 80%, and operating margins also between 25% and 40%. So it's a hugely profitable business. Of course, it comes with its own risk, that there could be competition, there could be regulatory risk, and all that is there. But I think it is another space where there is a large runway over a 10-year period where the size of these companies can grow. So now the PE multiples are definitely expensive, but if you look at the absolute size, 200, 500, 800 crore revenue size is not a big number. If you look at the 2 biggest companies in US, Quest Diagnostics and LabCorp, they are like 11 to 15 billion dollars in revenue. So can we go to 500 million, 100 million? Of course, those kind of numbers are possible over a 10-year period. So it is a very fertile space. Can we get it any cheaper? That remains open. I mean, I'm not sure if you can get it any cheaper, because the economics at this point of time of the business are very strong.
Is it like IT in 96, 97, the growth was great and the P multiples, they that time looked out of whack, but the growth rates were so high that you were forced to buy them expensive?
So in this space, I don't believe the growth rate can be very high. They will be, so it's a distribution-led model where you have to expand geographically in concentric circles. So you cannot expand. A particular regional lab or a central lab can cater only to a 500-kilometer radius. Okay. So you will have to put more and more labs to expand. So and even though it is a fragmented market, it is not an under-penetrated market in that sense. Anybody who falls sick does get some kind of a test done somewhere. So of course, with awareness, we'll be doing much more tests. I mean, today I might go for a preventive health checkup without any doctor suggesting something. So the trends are favorable, and the growth rate, in my opinion, will be in 15 to 25% range. They will not be as high as 100% what the technology used to quote at. But yeah, so at this point of time, if you are buying, you are probably sacrificing a year of growth.
Which is fair.
That is how you should be looking at it.
Which is fair.
Yeah.
Because this is a very efficient market, and with the use of technology and with the use of other instruments, efficiency only is going to go higher and higher. The buzzword on the street this year is NBFC. Everything and anything in the NBFC space is up from 30 to about 70%. A gold finance company like Muthoot is up 60% from the recent low. Chola is up 70% this year. I was looking at numbers in the morning. What's going on there?
So I don't think that's about to stop also at this point of time. So there's a lot of space that has been left vacant, whether it is on the retail side, whether it is in the rural side.
Because PSU banks are losing market share and they are keeping the market share open, and NBFCs are buying.
Needs are not being met by the traditional banks, or whether it is a retail or whether it is a rural consumer. And those needs are being met by these dynamic NBFCs or the microfinance guys, and their growth rates are tremendous. So I would say for them it's a huge opportunity and they are growing very fast. So just based on valuation, we might not see a big correction. There has to be a turn in cycle, and maybe the crisis has to emerge somewhere for the valuations to come down.
What do you like within NBFC? Let's dissect it. Consumer facing NBFCs, or maybe gold facing NBFCs, or NBFCs which are specialized NBFCs. They are only giving loans to truck financiers and only financing second-hand trucks. What do you like there?
Right. So we do not have any kind of preference for the space they are operating in. But what we look for in an NBFC is that they are conservative lenders is the first. Second, of course, they should be addressing a lucrative space. The ability to earn anywhere between 7-8% to spreads kind of 7-8% to 11-12%. Those kind of spread exists only in certain areas. I mean, whether it's rural, whether it's microfinance, whether it is consumer finance. So they should be addressing that kind of a space which is lucrative. And third, they should have the ability to move from a market to market. If, like for example, I mean, I'll not name any company, but if one of the best performer has been dynamic enough to move from a consumer segment to another consumer segment, wherever they see an opportunity, they should be able to move. So that is what we look for in an NBFC.
What identifies Ravi from other fund managers is that when you identified Tata Motors, when you bought TVS Motors, your call on Britannia, right ahead of the curve. So what do you think would be those big ideas? What do you think you would like to be identified as the next 3 years?
So we've spoken about it earlier, Nikunj, but the big call of the next 10 years for India has to be consumption. The Indian consumer is going to come of age. So India is about 65-70% service economy and a consumer-based economy. And this consumer is coming of age. Now they have availability of products, they have awareness of the products, they have availability of financing, and they have the desire to move up in life. And this is a mega wave that is going to override most of the things in India. So, which is any company addressing that kind of an opportunity is what excites us.
Now, that's a very headline-making statement, right? That's not your style. So let's talk about your style. How are you betting in consumers?
No, so what we spoke about, diagnostics is one such thing where people move up in life.
Yeah.
But another thing that we like is branded apparels. I believe Indians are the trend of more working women, the trend of more globalized. As we consume more global entertainment, we are aware of what brands are out there, and they become available. I mean, there are so many brands that have come to India in the last 3-4 years than they were earlier. Zara, for example,
the numbers are phenomenal.
The numbers are phenomenal.
H&M is here.
In 5 years, they have reached a scale unimaginable. So Zara, H&M, many more players are coming. Forever 21 has tied up with.
So to drop a hint for our viewers, you essentially buying branded retail players which are housing some local and global brands.
Yes. Yeah.
But the growth is not very strong.
Yes, current growth is not very strong, but that is not one should be looking at, which is why the stocks are available a little cheap, because the cyclical factors are working against this sector. I mean, there has been no wage growth, There has been no employment growth in the last 3, 4, 5 years, which is important for a consumer to start spending on it. And these are discretionary items. But if you are buying right now, when the times are bad, I'm sure in the next 5 years, you cannot but make money in this.
You know, a year ago on the same forum, you said, I don't think the capex cycle would revive. And I looked at this ceiling. I said, come on, the capex cycle is the strongest theme every fund manager is betting on. So consciously, you avoided buying into industrials and cyclicals.
Yes.
That call has worked for you.
Yes.
But is it time to change opinion now?
So we definitely are now more willing to look at companies that are on the industrial side. But if some company is dependent on capex picking up in a big way, is not what we are looking at. But manufacturing sector, whether it is auto anks or whether it is some agri machinery, those kind of things we would be willing to look at. But the big capex cycle is not about to revive still, in my opinion, because see, first of all, the companies are operating still at close to 65-70% kind of utilization. They'll take at least 2 years. They need to see 2 years of cash flows and profits and high utilization for them to even think about putting a capex. So there has been capex from the government side, and there has been capex from the foreign players side or select private sector. But as a wave, I don't think that's the theme that we want to play for the next 3, 4, 5 years.
So the outsize bet, according to you currently, is consumption within consumption, branded retail or branded apparel companies, a little bit of diagnostics. Pharma is the evergreen theme according to you, but you should be very, very stock specific.
Yeah.
And when it comes to a multi-year mega trend, it is specialty chemicals.
Yeah, specialty consumption, and of course specialty chemical is not a domestic theme. It is more the shift of business from China to Europe, and the domestic theme, that mega trend, is the consumption.
Every investor aspires to have a multi-bagger.
Sure.
So where do you think that multi-bagger will come from?
So find a company that will compound its earnings 25%, and that's where you have your multi-bagger. But it is very difficult to say today which company is going to do that year after year after year. I mean, Asian Paints was an expensive stock in 2009. At the bottom of the market was a 24p multiple, but it has gone up 5x, 7x from there. So, I mean, we have to find companies that are these cash generating machines and that will compound their earnings at a rate of 25%. And these are the areas, we have to pick and choose which we believe are the best in terms of execution. You
represent a family which is a family known for investing. You've been actively managing money for nearly a decade now.
Yeah, 6-7 years.
6-7 years, now almost there.
Yeah.
What is that one thing you've learned, and how your approach has changed in last 6 years? I mean, day one when you accepted public money versus now, what has changed for you as an investor and what has changed for your fund?
So we started appreciating the quality of balance sheet much more. I think there is a realization that it's not only the P&L based investing that works. A company that manages its balance sheet well is where they are the ones who will do well in the long run. And second, I believe a lot of learning is on the management front. I mean, your interest should be aligned with the management owners. If that is the case, then you have a winner.
Now we started with the term bull market. Let's close today's discussion and today's very interesting discussion with your definition of the bull market. According to you, this is not 2003, but we are in a bull market.
Correct.
So when it comes to a bull market, when do you think outsized gains would be made? Because ultimately that's the feature of the bull market.
Yeah, so the way I look at it is that, see, motherhood statement would be buy when everybody is fearful, sell when everybody is greedy, or buy at the point of maximum pessimism, or sell at the point of maximum optimism. But those points come like twice in a decade. The 2009 was the point of maximum pessimism. Have we reached the point of maximum optimism? No. But we are somewhere along that path already, and maybe few years down the line we'll reach a point of maximum optimism. So I look at the bull market in that way. It's the journey of going from maximum pessimism to maximum optimism.
Where are we right now?
We are definitely not close to maximum optimism, but I would say we have crossed more than 50% of the journey.
It's been very encouraging to understand a whole range of views on the mega trends to the definition of bull market and what your current assessment of the global economy is. Wonderful to have you back, and thank you for joining us.
Thank you so much, Nikunj.
That's it on this edition of Market Makers. I'm Nikunj Dalmas signing off. Thank you for tuning in. Thank you for watching the show.